Good afternoon, students. It's been a long time since the last DTLP class. Due to the prevailing conditions, we haven't had the chance to have any classes. So I'd like you to revise all the notes I've given before and make sure you understand the theory part of this topic before we go on further. So we'll continue with our topic, income from house property. Income from house property is a separate income head for calculating the tax payable by an assessee. For the purpose of calculating tax, we first have to find out the annual value or annual rental value. What is annual value or annual rental value? Under section 21, under section 23(1) of Income Tax Act, it defined the word annual value as the sum for which the property might reasonably be expected to let from year to year. Okay, in other words, the annual value is the value which any house can fetch from the market under the prevailing circumstances, such as local conditions, demand for the house, municipal valuation, standard of construction, rent for similar type of house in a similar type of locality. In simple words, it is the expected cost of rent for a let out property in a particular locality. How do we find out annual value or annual rental value? In a house property can be of two types. It can either be let out house property or it can be a self-occupied house property. A let out house property is a house that is let out for rent, whereas the self-occupied is used as a residence by the assessee himself. The annual value is calculated differently in these two situations, which we will be doing. Annual value of let out property. A let out property may face different situations over the year, so based on the situations, we will learn how to find out the annual value. Condition number 1. Under the first condition, house property is let out for a full year and there is no vacancy, which means the house property is occupied by tenants throughout the year. How do we find out the ARV in such a situation? Here it is given the different information needed in order to find out ARV. We have the MRV or the municipal rental value at rupees 60,000, fair rental value at rupees 66,000, standard rent at rupees 69,000. The actual rent is rupees 7,000 per month. Okay, so step 1. First, we have to find out the expected rental value. In order to find out the expected rental value, we have to first compare the MRV with the FRV. Whichever is higher will be taken. Here, the FRV is 66,000, so it will be taken. Okay, this value will be compared with the standard rent. Here standard rent is 69,000 and whichever is lower will be your ERV. So comparing the 66,000 with a standard rent of 69,000, we get ERV, which is rupees 66,000, since 66,000 is lower. Step 2. In step 2, we find out the annual rental value. In this step, we have to take the actual rent received. The actual rent received or receivable will be compared with the expected rental value. Whichever is higher will be your annual value. ERV is rupees 66,000. Actual rent is 7,000 into 12, which comes to 84,000 for the whole year, which is higher than the ERV. So in this problem, ERV will be your annual value. Your actual rent will be your annual value. I hope you've understood that portion. So we'll go to condition number 2. In this situation, the house is let out and there is vacancy in some of the months. If the house was vacant for a full year, the ARV is taken as nil. That means we do not have to calculate anything since it is nil. Okay, if the house property was vacant for a part of the year, okay, this is how we'll find out the ARV. Step 1, we'll find the ERV, which is the same as the previous problem. Next step, we find the ARV. After finding out the annual rental value, we deduct the loss due to vacancy and we will get the final answer or the final ARV. This is an example. Here, same problem, I've added just another condition in which in this problem the house was vacant for 2 months. Okay, step 1, we find ERV, same as the previous question, which we got 66,000. Step 2, we find the ARV, again same as the previous question, that is number 1. ARV is 84,000. So from 84,000 we deduct the loss due to vacancy. Here the total actual rent is 84,000 into 2 months by 12, which will come to 14,000. So your annual rental value, the final annual rental value is 70,000. This is your answer. Third condition. Here the house property is let out and there is unrealized rent. That means the house property is not vacant, but the owner did not get the amount of rent in some of the months. That means the tenant has not paid the rent in some of the months. Okay, same how to find ARV. First find ERV. Second step, your annual rental value. Okay, however there is some changes in this step. Okay, the actual rent will be taken after deducting unrealized rent. Okay, remember we have to compare the actual rent with ERV. So the actual rent taken for this step, we will have to deduct the unrealized rent first. This is the problem. Okay, same conditions, okay, which added, only this condition is added. During the previous year there was unrealized rent for 2 months. This is your solution. ERV same as question 1. Okay, here we have 66,000. Actual rent received is 7,000 into 10 because we did not receive the rent for 2 months. So actual rent is 70,000. Actual rent is higher than ERV, so your annual rental value will be 70,000. I hope that's clear. Okay, fourth condition. The house property is let out. There is both vacancy and unrealized rent. Condition number 4. How do we find ARV? Here again, in this situation, there is both vacancy and there is unrealized rent. So we just have to apply the steps which we have learned in the previous condition. We just apply it here. So step 1, we find ERV. Step 2, here again the unrealized rent will be deducted from the actual rent before finding out the ARV. And step 3, we will deduct the loss due to vacancy. This is the problem. Same condition, same amount. Okay, only this added condition is given. There was vacancy for 2 months during the previous year and the assessee could not realize rent for 2 months. Okay, ERV is equal to 66,000. actual rent received, since there was unrealized rent for 2 months, so the actual rent will be 7,000 into 10, not 12. So your actual rent is rupees 70,000. Actual rent is higher than ERV, so your annual rental value will be 70,000. Here we will deduct the loss due to vacancy. Loss again due to vacancy is for 2 months, so 7,000 into 2, which comes to 14,000. So the final annual rental value is 56,000. I hope you have understood the problems or how to find out the ARV in all these 4 conditions. Okay, these problems you'll have to try out by yourself. 3 problems in total. Thank you.